Good morning, everyone, and welcome once again to the Nedgroup Investments Stable Fund webcast for Q3. My name is Anil Jagmohan, Senior Investment Analyst at Nedgroup Investments. I'm at the offices of Ford Asset Management in Cape Town this morning, and joining me we have William Fraser and Nick Balkan, both of whom are multi-council portfolio managers of the Nedgroup Stable Fund. William, over to you.
Thanks, Anil. So before we start with the slides, I think the one point I'll make is that since the previous update on the fund, the strategy has effectively remained pretty consistent. There hasn't been any major changes to the asset allocation of the fund. Within the fixed interest side, we've retained the holding to bonds, and we prefer bonds relative to cash, in particular the one at 6. And then we've also retained the high allocation to offshore assets, which we think through a cycle will deliver superior real returns relative to domestic equities. And if one looks at slide 2, one can see year to date there's been absolutely no place to hide unless you had a decent allocation to resources as well as some bond exposure. Those are the only two asset classes that delivered positive returns. Property, financials and industrials all deliver quite heavy negative returns. In quarter 3, one can see that the experience is even worse, where there hasn't been any local sector effectively that delivered positive returns, including the local bond index. So longer duration bonds also delivered negative returns, given that the yields moved significantly higher in quarter 3 at the longer end of the curve. And industrials in particular was the heavyweight towards Naspers. One can see just how that index has suffered. The fund that we've spoken about, Naspers, the stable fund has no exposure to Naspers. So at least we've been sheltered to some extent from the no allocation towards that stock. In global markets, it's a pretty similar story in dollar terms. So unless you had very high allocation to the US and within US tech, your returns would be quite negative in absolute terms in dollars. So one can see that developed markets has delivered better returns compared to emerging markets. But that developed market returns really has been driven by the US market. And you know, the tech heavy component of that index has driven the returns rather than the overall market index. 60% of companies within the S&P has suffered 20% losses or more since their peak. So one can see that the concentration is significantly, or the concentration of returns is towards a handful of the larger cap tech companies. So if one looks at what contributed towards the returns, in particular in quarter 3, it's really been all about that bond exposure. So fixed interest delivered a positive 0.7% to the overall fund returns, and then the offshore component 1.3%. That's for quarter 3. The domestic equity component was slightly negative. We have a low allocation to equities. One can see that for the most part in quarter 3, the majority of the equities actually delivered a positive return. The capped SWIX was down 1%, but both Billiton, Sasol, Richemont, Price and RMH delivered decent returns for the quarter. It's really all been about Aspen, which is a low allocation in the fund, but one can see that subsequent to the earnings release, which disappointed the market and had a relatively high multiple, how that stock was punished subsequent to the earnings. And BAT and SPAR and Standard Bank suffered marginal negative returns for the quarter. And a very similar story for the year to date. So I'm not going to spend too much time on the year to date, but again, it's all about the bond and cash plus the foreign allocation that is driving returns and has driven returns for the fund for the year to date. I've got a couple of slides on the international fund. I mean, if you look at the foreign weighting of the portfolio, we have a significantly bigger allocation to the Ford International Fund relative to the Ford Global Equity Fund. And that orange line just indicates what we try and achieve through cycles for investors that's invested in this fund, which is preserve capital in the tougher times through a more conservatively positioned portfolio at the peak of the cycle and when risks are higher. And we think that preservation of capital will contribute towards a much smoother overall return profile through the cycle compared to global equities. And because of the preservation of capital component, grow return significantly ahead of inflation in dollar terms. So the allocation towards the different asset classes in the international fund is still relatively skewed towards equities, so about 63% in equities, but that allocation has drifted lower since the start of the year. We've had very close to an 80% allocation to equities not that long ago. And then within the different sectors, one can see, if you look at healthcare in particular and consumer staples, that we are increasing that defensive component of the portfolio. So we are concerned about where we are in the cycle. We think we're very close to the end of the 8th innings, if not closer to the 9th innings. So it's all about making sure that we're not overly exposed to geared investments, as I mentioned, given where we are in terms of the cycle and what could happen to interest rates from this point forward. And this lastly, 2 slides that we've showed before. The one is on bonds. I've mentioned that we've retained the bond allocation. The yield on the 1 at 6 has drifted slightly higher in the last 3 months or so, sitting at about 9.2% today. It has a modified duration of 5.5 years, and now one of the reasons we prefer the 1 at 6 is that given the high coupon, your running yield at a yield of 9.2% is very close to 10%. So even if interest rates continue to rise through the cycle, and even if bond yields continue to move higher, the yields need to move significantly higher to underperform cash through the cycle. So that very high coupon, we think, is critical at this stage, given that inflation is increasing marginally, but we don't think it will increase significantly enough to derail the investment in the 1 at 6 relative to cash, which could increase as the repo rate increase. So we think it's a pretty defensive position and likely to contribute meaningfully to real returns for investors. And then just lastly, one slide on a potential risk that's unfolding is the expectations for earnings. And we know that the US in particular is a very highly rated market. It's as long as the earnings come through, there's no real risk to, in our opinion, to the index level of the S&P. But if negative sentiment continue to increase at a time where what you see here is the earnings expectations continue to turn negative, then there is the risk of investors becoming more skeptical about the future returns on the US equity market in particular. So we are underweight that market, and we're underweight for reasons not only because of earnings, but given where we are in the cycle and the rating, we can find much better value in other parts of the world. So we're not out of equities. We continue to own global equities, and if one looks at the global equity fund, even though we still have an allocation towards the US and it's close to 40%, we can find much better value in other parts of the globe. Okay, that's a presentation. Let's open for questions if there's any, and we can take it from there.
Thank you very much, sir. Ladies and gentlemen, at this time, if you do have a question, please press star and then 1 on your touchtone phone. If you decide to withdraw your question, please press star and then 2 to remove yourself from the queue. And if you wish to ask a question, please press star and then 1 now.
Chris, while we're waiting, maybe I can just kick off. William and Nick, I mean, the currency has been making quite a lot of headlines recently. Just your thoughts on current levels, where's fair value in your opinion and so on.
And we don't like to use the term fair value. Currencies go where the market wants them to go. But if one look at what is happening globally, there's a withdrawal of liquidity because of what's happening to central banks. Interest rates are increasing in developed markets, in some emerging markets as well, so the cost of money is increasing. And we need to rely on global savings to fund our current account deficit. We don't save internally, and without that savings, there can't be investment. So we have to rely on external savings to allow for investment in the economy locally. So all these pressures, if you look at global liquidity withdrawal and rates moving higher, means that the rand is likely to be a weaker currency over time, given that we have quite a big external deficit. So the current account deficit is likely to be 3% plus over the next couple of years. And then we have a budget deficit, so an internal deficit that is moving in the wrong direction. And one can see, if you look at the MTBBS statement, that Treasury has revised the deficit to 4% plus minus for the next 3 years or so, which puts extra pressure on the need to fund that deficit through higher bond issuances. So if one just look at the direction of the currency, it needs to compensate investors for the increased risk of investing in an economy like SA, which, if the cycle unfolds like it typically does, we're close to the end of the cycle, and that's not a great time for emerging markets in particular. Money move towards safe havens, and that can lead to outflows out of our investment markets as well. So we don't believe that the rand is significantly undervalued or overvalued. It's probably close to fair value, but the risk definitely is for the currency to be weaker over the next 3 years rather than stronger.
Yeah, that's how I would have summarized it. I think we'd have never put spot forecast, but we have put out charts from time to time where we think roughly 1450, right? You can put a band around that for, where we are. But roughly that kind of number is, fair value using unit labor costs. But it's very seldom that it actually spends time at fair value, right? This is the thing with the currency. It actually spends more time away from fair value than actually at fair value. And you need to know which side of the risk curve you're on. As William alluded to, the risk from our perspective is that you spend more time above, meaning a weaker rand, fair value coming up to all the things William spoke about, than the other way. Coupled with that, we still think that outside of South Africa, the opportunity set is better than opportunity set within South Africa. So the rand is not particularly expensive. There's a risk that it can be weaker, but then also we can find shares that will do better globally than we can in South Africa, and that's why we structured the portfolio the way it is.
Brilliant. Thanks. Chris, any questions on the line so far?
No questions in the queue at the moment, sir.
Okay, William, maybe just on the global side as well. So consumer staples for a very long time have been extremely expensive, and typically for years investors have used them as bond proxies effectively. And now with US yields increasing, a lot of those consumer staples companies have taken quite a big hit. But potentially there are some very attractive qualities that they do display. So what are some of the exciting opportunities you're finding there? As the prices have come down.
I'll try and go, and then Will can add. Every cycle is different. We'd love to own companies that have stable earnings and will protect on the downside. But there's two sides to every coin. Like a staple needs to be defensive, but it also needs to have some sort of future prospects that's not implied in the price. The problem is because a lot of them have acted like bond proxies, in our minds, not really the place to protect an investor's money for the ultra long term right now. So if you see our weights in our funds, yes, we have staples and they are there, but it definitely wouldn't have been at the extreme number that it would have been at pre-internet bubble type protection levels. So there's a role to play, and we've got Johnson & Johnson, and we've got, the typical staples that you'd know about, right? I could go to the whole list. But what I rather wanted to say is, I guess this time we've been slightly different in the way we've dealt with the protection side of things. So as Will's got on slide 8, which if we can go back to slide 8, I'll try and get us back to slide 8 so I can refer to the numbers. You can see that healthcare is a very big portion of the Ford International. Healthcare has attributes of a stable type company. It comes with additional risk in that there is obsolescence risk and other that you don't get out of a Coca-Cola. But the problem is we think that people are paying too high a price for that stability. That will, yes, protect you on the downside, but when you look 5 years out in a way, they're not going to grow their earnings very much either. So what we've chosen to do, I guess, is take on slightly more volatility to be in a, Roche, which is a big pharmaceutical company, at like a 13 times PE versus the big staples like a Campbell's Soup, which is more than a 20 times with poorer long-term prospects, but will probably be a bit more stable in a sell-off. But looking through a cycle, you need to also provide your investor with a return. So we've kind of taken a different tack this time, that stocks like CVS that are M&A type opportunities that trade on an 8 PE and have value unlocked by merging, and companies like healthcare, which are probably unfortunately sold off and therefore have a better rating entry, will be a better way to protect our investors than the traditional 20 times big staples that you would have expected out of Ford International. The pharmaceutical healthcare sector will still be very stable, but it might not be as stable in a sell-off. Mm-hmm. But long term, it's a better risk-reward place to be.
Yeah. And Nick, you mentioned CVS. It just seems to be quite interesting how vertical integration can unlock synergies and add value over the long term.
Yeah. The vertical integration, you always got to be cautious with any M&A. M&A is, an organic business is always preferable to an M&A-led company because it's developing its own internal cash flow and it's probably got an organic growth. But then again, the sell-off that the M&A did to the share price provided opportunity, right? I think the integration and combining, for those who aren't that close to the detail, effectively, CVS is a combination of, I always like to use South African examples so people can understand. It's the combination of clicks and effectively discovery together. And there's a huge reform coming in the US healthcare where there's going to be clinics attached to every single CVS, which is the clicks. And that'll help bring down healthcare spending, which will help the health insurer. So it's that integration of the two that is important. Why it's important also is that it minimizes the Amazon threat, because CVS is always more at risk theoretically from being taken on by Amazon in the pharmaceutical side of things. So this has de-emphasized that side of the business, but it's emphasized the good side, which is the insurer side, yet you're still getting it at an 8.5 PE. So I don't want to overemphasize the synergies. I'd rather emphasize that it's been sold off and it's a better in combination, well-balanced business rather than there's going to be a huge amount of expenses or revenue synergies as a result. It was a very cash-generative business, CVS. They took the opportunity to use their balance sheet to buy a great business at a reasonable price in Aetna.
Great. Chris, any questions on the line?
Still no questions on the queue, sir.
Okay, great. Maybe my last question for today then and for today's call, just if you look at the R186, I know you've been moving your allocation towards the R186 over time, and besides the yield, which is quite attractive, liquidity is also quite attractive in the R186 relative to some of the other bonds in the curve. Maybe you just want to touch on that a bit.
Yeah, liquidity is critical. If you want to take advantage of opportunities that present themselves in liquidity-driven sell-offs in markets, you can only really benefit if you can have a cash resource, either so cash in a fund or a very liquid asset that you can sell in order to generate cash. So the obviously the one party is buying, you want to buy cheaply, but you also want to be able to liquidate an asset to take advantage of that opportunity. And that's why the 186 for us is almost a liquid asset. That's a short duration, so your convexity and your duration won't get as much affected by higher interest rates, but it's quasi cash for us.
And it's not as long a duration as suggested by the name of the bond, effectively, because of the high coupon.
Exactly.
So what's the modified duration?
Yeah, it has a maturity date of 2026, but the modified duration is 5.5 years, given that the coupon is 10.5%.
So we're not going that far out on the yield curve, as it seems when you see the expiry or the redemption.
Yeah. I mean, you can go. The yield you can get on a 2035 bond is 10.1%, but the coupon is only 8.85, and it's far less liquid. But if you compare your actual interest yield on that 2035 bond, it is 9.8% as well. So people often look at just the yield to maturity and think they're buying a superior return through the cycle, but they're not, because of the interest income into the portfolio. So the coupon plays a big part in the actual running yield that investors get by buying the bond.
You're getting a lot more upfront quicker than waiting for your return through time.
Yeah, and I think that in combination with these volatile markets, liquidity becomes hugely important at times like this.
Absolutely. Yeah, we've chosen not. We've always said to try and maximize the yearly yield. We could have bought more corporate bonds. You'll notice also that there's very few corporate bonds in this fund, which means we could have enhanced the yield quite easily and given investors, I guess, an additional return of more than 1% on our fixed income side of things by taking on additional risk. What kind of happens there is it's a bit of a mirage in that spreads will blow out there faster than the 186. So whatever you got in the first few years from getting the higher yield in tough times will come back at you from derating those corporate bonds, and you'll never be able to sell them to buy anything else. So that liquidity, I guess, has cost the short-term performance because we haven't enhanced risk to a certain extent, but that liquidity will come in handy when we need it.
Okay, brilliant. William, Nick, thanks very much for your time, and thanks very much to all of our valued investors for dialing in and taking out time from your busy schedules. Thanks very much. Have a wonderful week ahead.